When you sell a piece of commercial real estate at a massive profit, the tax code offers you a profound gift, the 1031 exchange. It allows you to defer the capital gains taxes entirely, provided you reinvest those proceeds into a new like-kind property. It is an engine of generational wealth in American real estate. But when you try to apply that same powerful engine to a senior living facility, the machinery often breaks down. You can't 1031 a nursing home, not the whole thing. When investors sell a skilled nursing facility or an assisted living community, they assume the entire payout qualifies for a 1031 exchange. But the IRS draws a hard line. You didn't sell a building. You sold patient rosters, operational goodwill, clinical licenses, and medical equipment. None of those operational assets qualify for a 1031 exchange. Only the real property does. And if you don't know how to separate the two before the transaction occurs, you will trigger a tax event that can wipe out millions in anticipated capital. The secret to protecting those gains isn't found at the closing table. It's found in the structural architecture of the deal. And that's what we're unpacking today. Hello, I'm Jovi Shari Brown, and welcome to the Sweet Spot Tax Podcast. In each episode, we take a deep dive into a Georgia Peach income tax sweet spot source document written by me. Guided by brief musical transitions, we'll explore 5 key areas: the deep dive, the psychology behind it, the sweet spot shift, actionable takeaways, and the clarity check. Along the way, we'll expand on the source document and explore the ideas, strategy, and questions behind it. Our goal is simple: to take complex topics and break them down into clear, practical ideas that are easy to understand and apply. Whether the topic is tax strategy, business growth, financial clarity, navigating IRS challenges, or decision making, the objective remains the same: to help you think more clearly and move more intentionally. Let's align with your sweet spot and begin today's deep dive. Let's dive into this. The complexity of a 1031 exchange in the senior living sector lies in the IRS definition of like kind. The IRS is very strict. Real property must exchange for real property. When you sell a passive triple net lease warehouse, almost the entire value of the transaction is tied to the physical building and the land. But when you sell an ALF or a SNF, a significant portion of the purchase price is tied to the OpCo, the operating company. The OpCo holds the state licenses, employs the nursing staff, manages the Medicare and Medicaid billing, and holds the intangible goodwill of the business. Waiting until closing to plan your 1031 is already too late. The mistake many investors make is negotiating a top-line purchase price, signing the letter of intent, and then asking their CPA to figure out the exchange after the fact. By that point, the IRS has already decided what you sold. The sale of the OpCo, the operating company, is treated as the sale of a business. That portion is subject to capital gains taxes or, worse, ordinary income taxes on depreciation recapture. Only the value explicitly allocated to the real estate can be deferred. To successfully navigate this, sophisticated investors utilize an OpCo PropCo structure. This means legally and financially bifurcating the asset long before the sale. The PropCo, the property company, owns the physical real estate and the land. The OpCo leases the building from the PropCo and runs the clinical business. When it comes time to divest, the transaction is clearly divided. The sale of the PropCo enters the 1031 exchange, deferring the capital gains. The sale of the OpCo is handled separately, often requiring highly strategic allocation of the purchase price to minimize the immediate tax impact. Engaging a federally licensed enrolled agent early in this process increases the chance that the valuation assigned to the real estate versus the business operations is both mathematically defensible to the IRS and optimized for your tax efficiency. So, what's the psychology behind it? Why do so many successful investors fail to structure these deals correctly until it's too late? It comes down to a cognitive bias known as functional fixedness. We tend to perceive objects and systems only in the way they are traditionally used. In real estate, investors are conditioned to view a property as a single monolithic asset. You buy a building, you improve the building, you sell the building. When they enter the senior living space, their brain applies that same functional fixedness. They look at the nursing home and see one asset. They negotiate the deal based on the EBITDA, treating the real estate and the operations as an inseparable unit. The cognitive load required to mentally deconstruct the single asset into two distinct legal and financial entities, an OpCo and a PropCo, is high. It requires a shift from thinking like a traditional landlord to thinking like a corporate M&A strategist. Furthermore, the excitement and pressure of the deal-making process often trigger a form of tunnel vision. The focus is entirely on maximizing the top-line sale price and getting the buyer to the closing table. The structural tax implications are pushed to the periphery, treated as a minor administrative detail to be handled later. By the time the functional fixedness breaks and they realize the tax consequences of a unified sale, the contracts are signed, the allocations are set, and the leverage is gone. Overcoming this requires training your brain to see the structural anatomy of a deal before you ever look at the purchase price. If you want to increase the chances that your next transaction is structurally optimized for maximum tax deferral, consider booking a senior living tax strategy intensive. We'll continue our discussion in a moment. First, a brief word from Georgia Peach Income Tax.
Financial success creates opportunity, but it also creates complexity. Tax decisions affect more than forms. They affect your cash flow, your business, your peace of mind, and your long term financial future. That's why the Sweet Spot Tax podcast is powered by Georgia Peach Income Tax, strategic tax advisory, and IRS representation built for clarity. Whether you're planning ahead, facing an IRS notice, dealing with back taxes, organizing your business, or seeking a clearer path forward, Georgia Peach Income Tax helps you move from stress to strategy and from uncertainty to clarity. Visit www.georgiapeachtax.com to access tax calculators, educational resources, IRS tools, AI assisted insights, and practical guidance designed to help you make smarter financial decisions before money moves. If you're looking for strategic tax advisory, IRS representation, or personalized support, call 229 395 3625. And if you'd like ongoing education, tax insights, live discussions, and access to everything from free resources to premium and VIP tax strategy experiences, join the Sweet Spot Tax community on School. Because the goal isn't simply filing a tax return, the goal is making better financial decisions with confidence. Visit www.georgiapeachtax.com, call 229 395 3625, or join the Sweet Spot Tax community on School today. Georgia Peach Income Tax, protection, strategy, financial clarity.
Many investors view the OpCo PropCo structure simply as a bureaucratic hurdle, extra paperwork required to appease the IRS during a sale. The real power of this structure is that it fundamentally changes how you control and value your assets. That's the sweet spot shift. When you operate a senior living facility as a single entity, your risk is centralized. If the operational side faces a massive liability, say a severe clinical malpractice lawsuit or a Medicaid clawback, the physical real estate is exposed. One structure, two exits, maximum control. When you separate your senior living asset into a PropCo and an OpCo, you don't just protect your 1031 exchange. You create an impenetrable firewall around your wealth. The real estate sits in a PropCo shielded from the daily volatility of clinical operations, and when it's time to exit, you have options no single entity owner has. You can sell the operating business to a regional healthcare provider while retaining the real estate and collecting long-term lease income. Or you can sell the real estate to a REIT while continuing to run the highly profitable clinical operations. You move from having one illiquid high risk asset to having two distinct, highly strategic levers you can pull based on market conditions. You are no longer just a facility owner. You are a strategic portfolio manager. If today's discussion resonates with you, here are 3 practical actions you can take. Number 1, audit your current entity structure. If you currently own and operate a senior living facility under a single LLC or corporation, consult with your tax and legal advisors immediately about the feasibility of transitioning to an OpCo/PropCo model. Do this years before you intend to sell, as the IRS scrutinizes restructuring that happens immediately prior to a transaction. Number 2, control the purchase price allocation. When you are negotiating the sale of a senior living asset, do not let the buyer dictate the allocation of the value between the real estate, the equipment, and the goodwill. The buyer's tax incentives are often the exact opposite of yours. You must have your own tax strategist at the negotiation table to defend a high justifiable valuation for the real estate to maximize your 1031 exchange potential. Number 3, build your team before you sign the LOI. The complexity of separating operational value from real estate value in a senior living transaction requires a rare intersection of clinical knowledge, real estate expertise, and tax law. If you are preparing to acquire, divest, or convert a senior living asset and want to increase the chances your structure protects your capital, book a senior living tax strategy intensive at georgiapeachtax.com/senior living tax. In 90 minutes, we'll map out a structural architecture you need to maximize your 1031 exchange and shield your wealth. We've spent today's episode discussing 1031 exchanges, OpCo/PropCo structures, and the danger of functional fixedness. But perhaps the bigger lesson isn't about entity structuring at all. Perhaps it's all about the danger of oversimplification. The senior living sector offers incredible yields precisely because it is complex. It is a demanding, highly regulated intersection of hospitality, healthcare, and real estate. You cannot extract maximum value from a complex asset using simple strategies. Strategic investors understand that the real money in senior living isn't made by simply buying low and selling high. The real money is made in the margins. It is made by understanding exactly how the IRS views clinical goodwill versus physical dirt. It is made by building legal firewalls that protect appreciation from operational risk. Because the market will always pay you for the value of your asset, but the IRS will only let you keep that value if you have structured it correctly. The real question isn't whether your facility is profitable. The deeper question is whether the legal and tax architecture around that facility is strong enough to protect your profits when it's time to exit. And ask yourself, am I treating my complex healthcare assets with the structural respect they demand? Or am I relying on simple real estate strategies and hoping for the best? Remember, you can book your senior living tax strategy intensive at georgiapeachtax.com/senior living tax. That's today's clarity check. Thank you for listening to the Sweet Spot Tax Podcast. For more tools, resources, and strategic insights, visit www.georgiapeachtax.com. Join the Sweet Spot Tax community on School or call 229-395-3625. Again, visit www.georgiapeachtax.com. Join the Sweet Spot Tax community on School or call 229-395-3625. Whether you're looking for tax strategy, IRS representation, or greater financial clarity, we're here to help. Georgia Peach Income Tax, protection, strategy, financial clarity. Until next time, align with your sweet spot and move with clarity.